All right, so today we're going to talk about lecture 4, which I had posted onto Elms. And really what today is going to be about is talking about the process that we're going to go over in upcoming classes for doing valuation. So this next slide represents, in the PowerPoint, the process, excuse me, the process that we're going to follow this semester. And each number in the process is approximately 1 week of class time. So next week, as we start doing cash flow valuations, the first thing we're going to do is we're going to translate the financial statements into an economic format based on the historical statements so that, 1, helps us better understand the past, and 2, it puts us into a format that's easier to forecast for the future. So that's really why we're going to go through the pain we're going to go through next week. Then, right after the midterm, and by the way, starting next week, just about every class the rest of the semester, you will be working in Excel. So if you don't have access to one of the terminals in the room, strongly recommend you bring a laptop because you'll be using Excel in just about every class for the now to the rest of the semester. So the good news is if you don't know much about Excel, by the end of the semester, you will. Right? So starting after spring break, when you come back, we're then going to get into building a valuation model in Excel using these converted statements. Okay? So I'm going to teach you how to forecast and teach you how to create the financial valuation model. Then, as part of that model, we're going to spend some time on not just forecasting an explicit period of time, approximately 10 years. We're then going to forecast a continuing value period for the company. So we've got to forecast forever. And then we're going to talk about how to discount that to a present value, so what cost of capital to use and how to view risk. And then we're going to talk about how to turn that into a share price, financials to a share price. And then we're going to talk about how to interpret that and create valuation so we can get target share prices and buy, sell, hold recommendations. So that's really what the next 6 weeks or so of class are going to be about 1 week at a time on each of those topics. So as we get started with evaluation models, I think it's very important to remind ourselves that as we change valuation models, the value of the company itself doesn't change. Right? So just because we changed our approach to valuing the company doesn't mean we should get a different answer. The value of the company is the value of the company. Right? And that is just important to keep in mind as we go through these different methodologies. So in the reading for this week from our textbook, basically the textbook talked about different models that are used to value companies. And really, all these different models are just rearranged equations. Right? They still get you an identical answer. As a matter of fact, your final exam in this class, and again, exams are open book, your final exam in open computer, you'll have to use a computer in the exams, will be, I'm going to give you a series of financial statements that you'll have to convert into economic format, which will also include a forecast. So you have to convert the forecast. And then given the forecast, you'll have to value the company using the enterprise DCF method and the discounted economic profit method and show me that you get an identical answer using both of those methodologies. If you can do that on your final exam, you'll do well in the class. If you can't do that on your final exam, well, you won't do so well. But that's your final exam. That's half your final exam. Okay? All right, so with that in mind, of the 5 valuation methodologies on this PowerPoint slide, the first 2 are the ones that you're going to be held accountable for this semester to know how to do, what are called the enterprise DCF and the discounted economic profit method. So first we'll talk about enterprise DCF. Enterprise DCF is probably the most common method used in the world today to value companies. And it's based on net present value. So if you can do an NPV, you can do an enterprise DCF. And the primary input for the enterprise DCF model is going to be free cash flow. And that's part of the reason why we're going to convert these statements next week, because next week is all about creating free cash flows and forecasting, eventually, free cash flows. So we got to define what free cash flow is, and we got to put our financial statements into a free cash flow format. Once we've forecasted the free cash flows, we're going to have to discount them. So we're going to discount them using a weighted average cost of capital, or WACC for short. Another item about the enterprise DCF model is that it assumes a target capital structure for the firm. So one of the implicit assumptions of enterprise DCF is that we'll use a constant cost of capital to discount the cash flows, because we're going to have a target capital structure, so the debt and equity balance doesn't really change. So therefore, we can use a constant cost of capital when we discount the cash flows. So in practice, we typically hold the cost of capital constant, and we vary the cash flows in our valuation. Okay? And that's really what we're going to do when we go through this method. Right? The reason why enterprise DCF is over 90% of the real world cash flow valuations is because it's NPV. And finance people understand NPV, and NPV is extremely flexible. Right? Matter of fact, one of the benefits of NPV is it's additive. So one thing I can do is I could take a company, like let's say I'm working with Ingersoll Rand, and Ingersoll Rand has 3 businesses. One of their businesses is heating and air conditioning equipment. The other is they make golf carts, and they make security locks. They're actually about to spin off their security lock business. But the point is they have 3 separate business units. I could value each of the business units independently on a cash flow basis, add them together, get the overall value of the company. Right? Because again, NPV is flexible. It's additive that way. It's like adding projects together. I can add pieces of a business together. So that's why people really like NPV. It's very flexible. Right? So that's the method that we're going to spend most of our time on this semester. As a second methodology that we're going to learn how to do is what's called the discounted economic profit, or EP methodology, also known as economic value added, or EVA. Economic profit is about what's called spread. It's about the value that's added or destroyed during a period of time. If we forecast all of our future spreads, we get the forecasted change in value of the company. If we add that to the initial assets of the company, or the initial invested capital of the company, we basically get the valuation. So it's basically take whatever invested capital the company starts with, add the change in value over time, that becomes the value of the company. Right? You get the same answer as the DCF. That's one of the things we'll prove out this semester, but it does give you a little bit more insight, because it tells you how much value has been added or destroyed based on what was invested, and when was value being created by the company. So in order to do the economic profit-based model, the key driver is economic profit. So again, we'll need economic profits from our financial statements, not an accounting number. Again, part of the economic statement conversion next week. We will convert the statements to give us free cash flow. We'll convert the statements to give us economic profit. So we'll be able to cleanly do this valuation methodology. The next 3 methods on this page, I'm not going to hold you accountable for understanding how to do this semester, but I'll at least mention them in class today, so you'll understand the difference in those 3 methods versus the 2 that we're going to focus on. So the third method on this PowerPoint is something called APV, adjusted present value, right? And you should at least know what it is if you're in an interview or working with a company and they start talking about the APV method. What's different about the APV method is in the enterprise DCF method, we assume the capital structure of a company is a target, relatively constant capital structure. But what happens if the capital structure changes? The APV model was created to value the company as its capital structure changes. Capital structure being the amount of debt and equity in the firm. So if I'm going to add a substantial amount of debt or retire a substantial amount of debt, then APV is a model I might want to consider, because it values what's called the interest tax shields. Right? So when companies issue debt, debt is tax deductible. Tax deductibility of the debt means you pay less taxes. So the APV model values the tax shields, and it tells you how much value is created with tax shields. And where the APV model comes into play is if you're going to change the debt, then what I want to know is what's the impact on the tax shields, and what's the impact on the discount factor, and how do I simulate what could happen to both of those to optimize my capital structure to get the most value for myself. So as I said, it's a more specialized model. It's going to be one that you'll deal with, for example, if you get hired to work in private equity. So when Dell went private, private equity firms definitely did an APV model on Dell. Because one of the things the private equity firms will do is when they take you private, they'll load you up with a bunch of debt. Now, one thing that people fail to realize is that the debt will come from the private equity firms themselves. So I'm the private equity firm, I invest in you. I actually put a little bit of equity in, and the rest of it is debt that's owed to me. But it's convertible debt that converts back to common shares. So the idea is, while you're private, you pay me interest. That interest is tax deductible to you. So you actually save money on your taxes. But later, when I take you public again, I convert the debt back to equity, and then I actually make the money on the equity side. So private equity firms want to load the firm up with debt because they basically create tax shields, which transfers wealth from the government back to themselves. So private equity is all about manipulating tax shields to their favor and taking advantage of the rules that our government has set up to tax advantage debt. Because if we issue debt, we can deduct that as a cost of doing business. If we have dividends, we can't deduct that as a cost of doing business. So equity is not tax deductible, debt is. That's what APV is all about. Okay? So fourth model, capital cash flow. We're not going to spend much time on capital cash flow because in the real world, I've never seen it actually used. I've only seen it used in an academic setting. And because these are just rearranged models, the idea of capital cash flow will become more apparent after next week. So next week, we're going to spend a lot of time taking the cash flows of a company and putting them into what are called operating cash flows, non-operating cash flows, and equity cash flow, debt cash flows. So the idea would be that if I'm valuing a business, regardless of how much debt it has, it shouldn't really change the value of the operations of the business. And I want to look at the value of the business regardless of its debt, because I can have two companies that have identical performance. One has debt, the other doesn't. The one with debt is going to look worse than the one that doesn't have debt on a financial statement. But it doesn't mean they're worse. It just means somebody chose a different financing options because they could theoretically both have the same margins and operating profits. So part of what we're going to do when we separate out and convert the financial statements is break out the operating versus debt part of the business. That's going to be very important to us because we want to look at the value of the business before it's financed and then figure out the appropriate amount of financing. Right? The capital cash flow method says you don't have to do that. Instead of breaking the cash flows into three components, valuing the three components and adding them up, you can leave the three components together and just value all the cash flows as one big blob. Right? So technically, it gets you the same answer. But practically, it doesn't give you any insight into the value of the firm. Because part of what we're going to do professionally and in this class is we really want to know the difference between operating and financial performance. The capital cash flow method says you don't have to get the value of the firm. So technically that's right. And I'm sure whoever did this in their PhD defense got a really good valuation, from their committee and said, great job. But practically in the real world, it's not used because it's just not useful information. So therefore, we're not going to spend much time on it. Model number 5, equity cash flow method. Equity cash flow method is what you use to value a bank or financial services company. So for example, when I'm working with Santander, Spanish bank, I'm going to be talking with them about the equity method. But it's too specialized for the time that we have with our class. But here's the general idea. If I value IBM and IBM has debt, it is very clear that debt at IBM is used to finance IBM long term. Right? So you're using debt to finance their business, and it's not part of their operations. So they have operating cash flows, and the debt is clearly a debt cash flow. So I can separate those out pretty easily. But if I'm valuing a bank, like Santander, it's a completely different story. Because for a bank makes loans. Loans are net interest income. Loans are the net interest they earn on the interest they charge you. Now that's financing. Loans, cost of goods sold, is the cost of the borrowed money that they use to lend out. So they'll pay you interest on a CD and then they'll use that money to then lend it out to somebody else. So for a bank, interest is operating. It's the revenue for the bank and it's the cost of goods sold for a bank. For a bank, interest is also long-term financing because banks will use long-term bonds to finance themselves long-term to finance the bank as opposed to individual loans. So for a bank, it's blurry. It's a very gray area as to whether debt is operating or whether debt is financing. And particularly as an outsider, it's very difficult to see the difference between the two. So for banks, we don't try. What we do is we value the cash flows to just the shareholders, right? So with a bank, we take the cash flow to shareholders, which is net income, and basically discount that cash flow to shareholders at a cost of equity. Enterprise DCF, free cash flow is the cash flow to the debt and the equity holders. We discount at the cost of the debt and the equity, the WACC, right? So traditional firms, free cash flow, discounted at the WACC. Banks, equity cash flows, discounted at the cost of equity. So essentially, you could do the same thing for a regular company. As a matter of fact, if you learned about the dividend discount model, the dividend discount model is an equity cash flow model, right? But the reason why we don't use the dividend discount model in the real world is because so few companies pay dividends, and the ones that do still buy back a lot of stock. So therefore, it's hard to use the dividend discount model when a lot of the cash flows that are going back are stock repurchases. You know, look at Apple. In the last 3 weeks, they bought back $14 billion worth of stock. So how do I use a different dividend discount model with that? I use the equity cash flow method to do that. So it's all the cash flows, dividends and share distributions to the equity holders, which come from the equity valuation of the firm. Anyways, it's a more specialized model. Because we have limited time this semester, we're not going to get into it. The textbook actually has a pretty good chapter at the back that talks about the equity method if you want to learn more about it as an overview. Supplemental reading of future choice. The only two I'm going to hold you responsible for are the first two. Enterprise DCF, discounted economic profit. Questions about any of that? All right. So, visual representation of enterprise DCF. So again, one of the things we're going to do is we're going to forecast the free cash flows of the business. And when we discount and sum them up, that's going to get us something called the enterprise value of the business. And assuming the company has no non-operating assets, that's the cash flow that pays off the debt holders and the shareholders. Payment to the debt holders, payment to the shareholders, total value of the debt payments, total value of the equity payments equals the total enterprise value of the firm. And that's kind of the premise that we're going to use to value the company. So take the enterprise value, pay off the debt, whatever's left goes to the equity holders. That's enterprise DCF. It's actually a relatively straightforward process. So this gets back to why it's a flexible model. So go back to my Ingersoll Rand example. I take the 3 business units of Ingersoll Rand, golf carts, security, and air conditioning and heating systems. And basically, I add those 3 together. I add those 3 businesses together. That gets me the overall value of the businesses. Then, companies often have what's called a corporate center. They got a C-suite, bunch of C-level executives, CEO, CFO, etc. They also have shared services, HR, accounting, finance, whatever. These don't generate revenue. So I subtract off the corporate center costs, the overhead, and then that gives me the operating value of the business. I might have some non-operating assets, a bunch of cash lying around. Add that in, and that gets me enterprise value. Assuming I have some debt, enterprise value minus debt, whatever's left, goes to the equity holders. In this case, if I had 560 of enterprise value, if I had 200 million of debt, 560 minus 200 is 360 of equity value. Divide that by shares equals share price. That is the method for enterprise DCF. So really, enterprise DCF is about 4 major items. And again, this is a lot of the work in the reorganizing of the statements that we're going to do is to put it into these 4 formats, 4 bucket formats. So first, it's about figuring out the operating cash flows. Well, to figure out operating cash flows, which are called free cash flows, I need to know what the free cash flows are. To get the free cash flows, I need to know NOPLAT. I need to know investment in capital, and I need to know invested capital. So again, that's a lot of what next week is going to be about. Then I need to know the non-operating value of the business. So I have to be able to distinguish between the operating and the non-operating value of the business. So I got to break the assets into those 2 categories. I'm going to combine those two values to get the enterprise value of the firm. Then I have to identify any debt claims, either interest-bearing debt or what I'll call debt by proxy, pay that off to figure out what the equity value is. So that's really the process that we're going to go through with repetition this semester. I'm going to skip over these next few slides because I've assumed you've read the book, and the book does a good job of explaining these topics. And I'm going to stop and pause on this kind of innocuous looking slide. But this is actually a very critically important slide. So this slide is a representation of how McKinsey does an enterprise DCF valuation. So little historical context. One of the co-authors of the book that we use is a guy by the name of David Wessels. And David and I have known each other, God, 15, 20 years. And I met him when he was a finance analyst at McKinsey in their New York office. And we were both teaching in McKinsey's analyst training program. It's called ATP. So when you're hired by McKinsey as an undergrad, they put you through a 4-week-long boot camp called the analyst training program to teach you all of their methodologies. And they also take people that have never done finance before, like they'll hire, an anthropologist or somebody like that, and they teach you business skills in 1 month. So everything you did in 4 years, they collapse to 30 days, and they just assume you're smart. And then they turn you out loose to be working as consultants with their clients. But during the boot camp, one of the things they do is they spend a week on finance, and as part of the financial week, we taught them how to convert statements. Matter of fact, that was my role at McKinsey at the time as a trainer. I wasn't employed by McKinsey, but I was brought in to basically train them on how to convert and analyze their financial statements. And actually what Wessels used to do is he would come in and he would teach them the key value driver formula, how it was derived, why it mattered, and how they would apply it, and doing some valuation stuff out of it. So long story short, Wessels went on to get his PhD at UCLA, and now he teaches at Wharton. But we're still really good friends. Matter of fact, next week at Santander, I'll be there with 5 days for him. So we teach during the day, and then we go out for drinks at night. So hopefully not too much, what are they called, tapas and drinks, whatever they have. Anyways, Spain's a great place. So back to this. How does this apply to us? Well, Wessels is one of the co-authors of this book. He's actually working on the next edition right now. But in the 5th edition, when they came out in 2009, he was working on 2008. He was actually working with Home Depot. That's how Home Depot showed up in the book. And they got permission from Home Depot to use publicly available information to do an example. Although the actual valuation McKinsey would do would be a little bit more detailed, but it represents their methodology. And so when we build our valuation models later this semester, we're going to build a spreadsheet that's going to have a worksheet that looks almost exactly like this, right? And here's the methodology that they're using. So for operating value, they estimate the free cash flow year by year for Home Depot. That's the cash flow generated primarily by people going and shopping at Home Depot stores. Right? That's where they make money on their stores. They forecast that until it becomes a meaningless forecast. Because when we value a company, we have to value the company as if it lives forever. So we have to forecast cash flows out forever. Well, after you go past 10 years, you're throwing darts at a board. So what Wessels did in this valuation is after year 10, they went into continuing value. So the continuing value is the key value drivers equation that we defined earlier this semester, which was the rearranged growing perpetuity formula to value the company from year 10 or 11 into perpetuity. Right? So we then had to present value these cash flows. So we estimate a WACC. And then we discount these free cash flows to a present value at the WACC. And the WACCs, the discount factors, come from the WACC. So again, the formula for present value is cash flow divided by 1 plus r to the power of t. If I take cash flow and I multiply by 1 over 1 plus r to the power of t, 1 over 1 plus r to the power of t, or n for number of years, is the discount factor, right? And that's just old school. Because back when I was in business school, a long time ago, we were just barely learning how to use Lotus 123. Excel really didn't even exist yet. And it was the days of VisiCalc. And we used to have HP, I'm trying to remember, it was 10B or 12C it's now like probably an archaeological relic. Matter of fact, you can actually buy it on your iPhone now to represent the HP calculator. But I still have mine in a box somewhere. I guess it's worth something. But in any event, we had HP calculators, and at the same time, we were allowed to bring into our exams 2 sheets of paper, and the 2 sheets of paper were computer printouts, where across the top were the discount factors, and down the rows were the number of periods. And the way we would discount a cash flow is we would just look it up on the table, and we'd multiply it by the cash flow, and that would be the discounted cash flow. So I'm just telling you, you'll see a lot of people in these textbooks, and Wessels is about my age, and he went to Wharton as well. And so when we were there, this is the way we discounted cash flows, is we took the cash flow, we multiplied it by the discount factor, and that equals the discounted free cash flow. So that's really what the discount factors represent. Discount factors represent 1 divided by 1 plus r to the power of t or n, depending on periods. And it's just a way of getting discounted free cash flows. So that's the point. I have my free cash flows. I put them into present value. I sum them together. I get the operating value of Home Depot. So 62,694 is an important number. It's going to come up again in just a few minutes. But that is the operating value of Home Depot, assuming these forecasts come true. Okay, so that's how much money they get from their operations. Now, here's something else McKinsey does that very few people do elsewhere. And it probably makes sense to do, but very few people do it. And later this semester, we're going to skip this step out of laziness, but it's probably something we should include in a valuation model. And here's the point. The present value is based on a discount rate. A discount rate, present value, takes the cash flow at the end of a period and brings it back to the beginning of the period. So if I forecast for a given year Home Depot's free cash flows, then what I'm really saying is all of that cash flow is generated on December 31st, and I'm putting it to a January 1st value. Well, that's not realistic because Home Depot doesn't generate all of their cash flow on December 31st. Home Depot is generating cash flow every single day. Matter of fact, today, when it's about to snow, there's probably a lot of people flooding Home Depot, buying a lot of stuff. So they're generating cash flow all the time as people walk in their stores. So I am undervaluing Home Depot if I use the present value equation because I don't give them any credit for doing cash throughout the year. So what McKinsey does is they take a half-year discount factor and they future value the entire valuation by a half year. So they basically move the valuation 6 months into the future. And the reason they're doing this is they're assuming that cash flows come in evenly throughout the year, as opposed to the end of the year. So for practical purposes, June 30th rather than December 31st. So you'll notice by future valuing the valuation that they're adding approximately $2.5 billion to the valuation. So this is not trivial to do, right? It actually has a big impact on your actual valuation. And I'm telling you, in the real world, almost no one does this. But theoretically, if you think about it, we should, because companies are penalized for having the present value formula applied to them, especially when we do it on an annualized basis. So that's McKinsey's way of mitigating that. Now, it's not a perfect methodology because, for example, let's say we were doing H&R Block. H&R Block, it's a tax company. Problem with them is they're not generating all their cash flows in June and July as well. In fact, H&R Block probably does almost nothing in June and July would be my guess because all of their revenues are earned during tax season. So again, the one challenge with this method is it assumes that the company is not cyclical even during a year. So you can actually get into really interesting debates about what is the appropriate discount factor and when do the cash flows actually come into the year. So it can get more complicated than it appears, but nonetheless, very few people do this in the real world. They should. Since we're going to keep some things simple this semester, we're probably not going to do this in our valuations. You could if you want to, but I just want to let you know that's why it's here on the page. So that's the value of operations after the mid-year adjustment. Then, next step, they take the non-operating assets and they add in the non-operating values. So, operating value plus non-operating value equals what's called enterprise value. And that is the cash available to the debt and equity holders. Next, what we have to do is identify all of the debt and debt equivalents. because if we pay off the debt, shareholders get the residual of what's left after everybody else has been paid. So enterprise value minus debt equals equity value of the firm. Matter of fact, divided by shares equals share price, equity value per share. That's the forecasted share price. That's the method that we're going to use for enterprise DCF. Now, again, it's a nuance, but an important one. If you look at the debt, $11,434 billion of debt was the debt that was actually on Home Depot's balance sheet at the time of the valuation. However, many of you will get jobs working for accounting firms like PwC and Ernst & Young, KPMG, etc., and you will get good and paid a lot of money by the accounting firms to help companies hide their debt. And you'll do it legally, but basically there's a big industry out there to make companies' balance sheets look better than they probably actually should be, hide liabilities. And it's perfectly legal, but one of the ways that liabilities are hidden are through leases, operating leases in particular. Does everybody know how an operating lease works? So think about it this way. Let's say I own a small business and I do deliveries. So I need to lease a car or truck to do my deliveries. So I sign a 3-year lease for a car or truck for 3 years. And let's just keep the math simple. It's $300 a month. So I have a lease that I signed today for a new car or truck for 3 years at $300 a month. So 12 months times 300 is $3,600 a year for 3 years. The way a lease works is that I am responsible as the business for that payment for the next 3 years. And I can't just hand back the keys. So if I don't like the car, I'm still stuck with that car or truck for 3 years. That's the whole point of a lease. I'm stuck with the payments. Here's my question. As a small business owner, how much liability do I add to my balance sheet when I sign that lease? Yeah.
None, because it's an expense.
That's right. The actual answer is none. The realistic answer is I have 3,600 times 3 of liability. But the actual answer, which makes no sense, but that's why they call it accounting, is 0. Right? Because the accountants say it's an operating lease. And the way an operating lease is, I don't show any of the liability. I just expense it every month as the lease payment is due, kind of like rent. So I just write off the lease cost. Right? So it's an advantage to me to lease versus buy. What would be different if I bought a car or truck and then financed it with a loan? What would I have to do on my balance sheet then? First, I'd have to put the car as an asset on my balance sheet. Second, I'd have to put the loan as a liability on my balance sheet because that's debt, right? And what I'm telling you is if you realistically think about this, there's not much of a difference between the two. If I buy a car, put the asset on the balance sheet, and owe the money for it, and I lease a car, I don't put the asset on the balance sheet, and I don't show the liability, but technically, I still own that car for that period of time, and I still owe the financing for that period of time. There's really not technically that much of a difference in the liability side. The only difference is I don't have to list it as a liability if it's an operating lease. And I'm telling you that companies have realized over time that most investors aren't sophisticated enough to track all the off-balance sheet items. They look at the balance sheets when they look at the debt, and they can make the balance sheets look better. So Home Depot was an example of this, that Home Depot leases a lot of stores. It's just easier for them to lease. But here's the point. If I'm valuing Home Depot and I don't realize they have over $8 billion of leases at the time, I'm going to misprice Home Depot because they had 1.7 billion shares. They had $8.3 billion worth of leases. Whatever that works out to, that's $5 or $6 a share. So I'm going to misprice Home Depot too high if I don't realize they have a lot of leases. And you might say, gee, is this a common issue? Ever heard of Starbucks? So here's what a naive investor would do. I'm going to go to Google Finance or Yahoo Finance. Ironically, Home Depot is about to hire 80,000 people, talking about them today. And I look up Starbucks. And I go to their financials. And I go to their balance sheet on an annualized basis. and I see on the last reported year for, which is this column, last reported year for Starbucks, total debt, $1.299 billion. That's their total long-term debt, and they don't have any short-term debt. So that's their total debt, about $1.3 billion. So if I value Starbucks, I figure out the value, I subtract the $1.3 billion, I get an equity value, because that's all they reported. Right? But here's the deal. So I open up another tab in my browser, and I go to the SEC website, sec.gov, because where Google and Yahoo Finance and Bloomberg and all these other sites got the information from Starbucks is from the SEC website. So companies have to file their information electronically with the SEC. So I can go to the filings for the SEC website, and I can go to what's called the Edgar database. And I can type in a company name like Starbucks. I can search for them. And I can see all of their filings with the SEC. Right? That's how the databases all scrape this data and aggregate it for us on our behalf, so we don't have to go here and do it ourselves. But here's the idea. Here's the last 10K, which is the annualized report that they filed with the SEC. They filed this on November 18th, 2013. Click on the documents. Here's the report in HTML format. I click on this. Here's the actual HTML 10K from Starbucks. Boring. Boring as hell. Written in a way that they have just nonsensical stuff that's stated. Because companies actually hire people to write these things so that nobody can understand them. It's actually an art. Because they don't want to have too much disclosure, so they fight the SEC by basically just making it impossible to read. I'm telling you, if you have insomnia, read a 10K. It's better than counting sheet. Put you right to sleep. All right. So I'm reading through this boring document, but this is where the bodies are buried. So I do a search. Control F. I want to look up lease. So I type in lease, and I do a search. There's 57 occurrences of leases, including please. There's a lot of pleases in here. So I'm just going to keep skipping the pleases. So I'm going to go down a few. And I get to page 15. On the bottom of page 15, after just random data on properties, is a very important line item that most people wouldn't even realize is an important line item. But here's what it says. It says, we own our roasting facilities and lease the majority of our warehousing and distribution locations. As of September 29, 2013, Starbucks had 10,194 company-operated stores, almost all of which are leased. We also lease space in various locations for regional, district, and administrative offices, training, and facilities. They're basically telling everybody they don't own any space. They're leasing everything. And these are operating leases. Right? So, why is this important? Keep going. I've fallen asleep. Blah, blah, blah. I get to page 37. If you make it to page 37, a lot of boring stuff between them, you see in this table, it's kind of buried in plain sight, operating lease obligations. $4,586,000,000. They go on to explain that these are non-cancelable leases. So they've signed leases that they have to pay over time that they can't get out of for $4.5 billion. None of that is on their balance sheet. And so what I'm telling you is even a company like Starbucks takes advantage of this. And they're taking advantage of basically hiding a bunch of debt in plain sight that if you don't bother to look in the financial statements, you will misprice Starbucks because you don't realize that they signed on to $4.5 billion worth of debt. Matter of fact, this became an issue with Netflix a couple years ago before Netflix growth started to take off because Netflix announced in their 10K, buried in the footnotes, that they had signed $3 billion of deals with Hollywood to basically pay for all the movies that people would eventually stream. And they were on the hook for paying Hollywood even if people didn't sign up for Netflix. And it freaked out a lot of investors because they're like, will people sign up? Because if not, Netflix is going to owe a lot of money for all this Hollywood content that they had signed as a contingent liability. And that was the point. It wasn't on their balance sheet. It was in the footnotes. And you don't read the footnotes, and you should, right? But that's the point. We're going to have to go looking through the footnotes to find some of these things. And leases are a big deal. So, back to this. When I price Starbucks, I need to include their leases. So this was the Home Depot equivalent. Enterprise value minus debt and what we'll call debt equivalents. Anything that we owe needs to go in there as well, because shareholders get what's left after everybody's been paid. These are contractual obligations, equals equity value divided by share price. That was enterprise DCF. Now, methodology number 2. Skip. You can read about this in the book. Method number 2 is the economic profit valuation methodology. What's different about the discounted economic profit methodology from the discounted cash flow is that everything from operating value below is the same. What's different is how they calculate operating value. So, how do we calculate operating value differently with the economic profit valuation? Now, here's the final answer. Notice that the operating value using this separate methodology is 62,694 before the mid-year adjustment factor, which is identical to the 62,694 operating value using the DCF method. As I said, this is your final exam. You have to show me that you can calculate both these methods independently, get the same answer. So, how do you do that? Well, first, you forecast economic profit. How do you forecast economic profit? It's a spread-based methodology. You need to forecast ROIC. WACC, ROIC minus WACC is spread. Spread times invested capital equals economic profit. All right. Another reason why we're converting economic statements. The converted economic statements will give us ROIC, will give us invested capital, will give us economic profit. Okay. So we forecast, just like we forecast the free cash flows, we forecast the economic profits. Economic profits are the one period change in value of the company. So we're forecasting the change in value year by year of Home Depot. We do that for the same period of the DCF and into perpetuity as well. This is the change in value of Home Depot for the first 9 years, change in value from 10 into infinity. We discount the change in value, discount the economic profits at the same WACC. So we get a discounted change in value. When we sum it up, the discounted change in value that Home Depot is adding to their assets is 25,619. Home Depot originally invested $37 billion in their business, 37,075. So they put in 37,075. They added $25.6 billion worth of value. When you add the two together, 62,694. So what economic profit valuation does is it creates the concept of what's called MVA, or market value added. So with a DCF, it just tells me how much value I could create. And one way I could create value is I could spend a lot of money. And I could spend an exorbitant amount of money, and I just create value because I throw a lot of money at the problem. And the assets that I spend have some worth. Or I could create value because I spend a little bit of money, and I use those assets extremely efficiently, and I create a lot of value with a small amount of assets. DCF doesn't tell me that. Economic profit does. So one of the advantages of the economic profit methodology is it tells you how much value you're creating or destroying with the actual investment you make in a business. The MBA, market value added. As a matter of fact, Fortune magazine used to every year, now they just do it every now and then, used to score companies based on market value added. Who's creating value, who's destroying value. So it's not just the stock price, it's stock price against investment. And how much did you spend to get that stock price? It's called MBA. Right? Number one on that list would be Apple, by the way. So, second thing economic profit tells you is when you're creating the value. Year by year. Am I creating or destroying value? So, for example, in the first year of the valuation, Home Depot is actually destroying value. It's only in the future years that it creates value, and the vast majority of the value at Home Depot is being created out in the continuing value period. And this is true for most companies. Most of the value is in the continuing value period. How much? And that's also why companies are very sensitive to changes in assumptions. Think about this. Twitter barely meets its revenue estimates. Analysts go back in, change the assumptions for continuing value to slightly lower growth rates. Huge impact on the valuation of Twitter. It would happen with any company, but that's the idea. Most of the value for Home Depot is 10 years out. So changes now are really inferring what I think is going to happen in a decade. But that's where most of the value is coming from in companies. All right, method number 3, APV. As I said, I'm not going to ask you to calculate it, but I at least want to show you how APV works. So here's the idea of APV. To do an adjusted present value valuation, I use the same free cash flows that I did in the DCF. So same free cash flows. Forecast those as well. In addition, I forecast what's called the interest tax yield. The interest tax yield is the interest expense the company pays times the tax rate, because that is the tax deductibility of what the company would not have to pay in taxes because they can deduct interest as a cost of doing business. So interest expense times tax rate equals interest tax yields. So I forecast my interest expense, I forecast my tax rate, I forecast my interest tax yields. I then discount both of these cash flows at a higher cost of equity, specifically an unlevered cost of equity, as if I were a 100% equity firm with no debt. Right? So rather than discounting the cash flows at a whack in an APV model, I discount the cash flows at a higher cost of equity. Okay? Specifically an unlevered cost of equity. So what does that practically mean? I discount my free cash flows at the cost of equity. I discount my interest tax yields at the cost of equity. This is the value of the operations with the free cash flows at the cost of equity. This is the value of the operations with the savings the interest tax yields generate for me. I add these two numbers together, 62,694. Question? All right, so here's my question. How much value does Home Depot get from having debt on its balance sheet? By having $12 billion of actual debt and $8 billion of leases, how much value does Home Depot get from that? Or another way of saying the same thing, what would be the value of Home Depot, their operations, if they had no debt and they were an all equity firm? What would the value of Home Depot as an all equity firm be? By the way, this is the example of the types of questions on part B of your midterm. All right, well, the 65,764 is the value of the operating and the non-operating cash flows. So I'm saying, what's the value of the company before the tax yields? So the operating value is 62,694, which includes the tax yields. So take away the tax yields. What is left? 53,240. That is the value of Home Depot as a debt-free company. So what I'm saying is, you can thank Uncle Sam, our government, for giving a corporate benefit to Home Depot by allowing them to deduct interest, and that is the subsidy that they're getting from the U.S. government. They're getting, by having debt, a $9.5 billion subsidy. That they would have $9.5 billion less value if they had no debt in their capital structure. That is what the APV model tells us. Right? So, here's the thing. It's cool information, but if you're not going to change your capital structure and you're not going to do anything about the debt, it's a lot of work to basically get some cool information. So the people that actually use this model start to say, okay, well, gee, what happens if I increase my debt? I get what? What's the benefit? I get more tax yields. What's the disadvantage of increasing my debt?
Well, you have to pay more for the debt.
I got to pay more for the debt. Translation, higher cost of equity. I take more risk. So what I do is I try and optimize. How much tax shield can I get? How much additional cost of equity do I have to pay? Where do I end up? What is optimal? And here's the thing. Unlike the academic setting, the real world is not as efficient as we'd like it to be. And companies can exploit these inefficiencies. So an example I'm actually using with Santander is this, which is a couple years ago, it's a company called Amgen, biotech company, big biotech, and they issued $5 billion worth of debt to buy back stock. And they actually told the investors, we are purely issuing the debt to buy back stock. They were changing their capital structure to have more debt and have less equity. So they're going to buy back the stock with the actual proceeds of the bonds. So they're going to issue some long-term debt. So when they issued the $5 billion worth of debt, the rating agencies rated their debt and they lowered their credit rating because they said if you're going to add $5 billion worth of debt, you're riskier, you're going to have a lower credit rating. We can go into a data service like Bloomberg, and it's not something we're going to use this much this semester, but it's actually just another cool feature of the Bloomberg service. So if I log into Bloomberg, one of the shortcuts in Bloomberg is YCRV, which stands for yield curve. YCRV. And as of today, this is the Treasury yield curve on U.S. government treasuries. This is the white line. This line right here, where'd it go? YCRV. This line right here is the yield on single A rated debt. This line right here is the yield on triple B rated debt. This line right here is the yield on double B rated debt for U.S. companies. So with a data service like Bloomberg, what they're doing is they're saying all the companies that they know are rated with a certain letter grade, they know the yield to maturity because they know the price of the bonds, they know the coupons of the bonds, they know today's interest rates. They calculate yield to maturities and they'll say, all right, for all AA rated securities, this is the yield to maturity of the AA's. For single A rated maturities, this is the yield to maturity that the single A's pay. So we can go to a data service like Bloomberg, it's part of their fixed income part of their service, and we can figure out what is the yield to maturity for a certain credit rating that companies should pay. So this is what happened with Amgen. So when Amgen had their credit rating lowered, you could go to a data service like Bloomberg and you could figure out what a lower credit rating should be paying as a yield on their interest. And when they price the bonds, they're going to put a coupon rate closer to that yield to maturity because that's what investors would expect, right? Because most bonds are sold close to par. So back to this. So at the time, this was 09, this was at post-financial crisis, the 2009-2010 range, and the market was still scared of poorly rated corporate debt. Everybody wanted to get, at the time, high-rated debt. So what ended up happening is they had their credit rating lowered. According to the credit rating, we knew what interest they should pay at their lower credit rating when they issued the bonds. But when the bonds actually got priced and bought on the market, they actually had a yield to maturity that was actually lower than the debt before they issued the $5 billion. So they actually issued $5 billion of debt at a lower yield to maturity than their credit rating before it was cut. So it's almost like they had an even credit rating upswing as opposed to a downswing. It's like they were upgraded by issuing $5 billion worth of debt. And it had more to do with the market dynamic at the time, the inefficiency of the market, where people just wanted investment grade company debt and they were willing to pay whatever price they could to get investment grade quality debt because everybody feared the bad stuff at the time. So what I'm telling you is Amgen and their bankers clearly exploited the inefficiency of the market to basically say, we think we can actually issue debt at a better rating than our current debt, much lower yield to maturity than we should be able to borrow, buy back the stock, have lower borrowing costs, and actually have less stock, and we can kind of pull a fast one on the market. And it's just because they exploited the inefficiency of the market. But that's the point. They used the APV model to also say, hey, here's the extra advantage of the tax shields, and here's the advantage of having fewer shares on the share price. This seems like an easy win for us because we have such demand for our debt because we're considered a credit-worthy firm. So I'm just telling you, these are the types of situations when you deal with APV. This is more of a specialized model for those situations. So again, other than what we've talked about today, I'm not going to hold you responsible for anything that we've just said in the last 5 minutes. It was more for curiosity, but that's the APV model. So if you ever deal with it, like I said, in an interview question, or you're dealing with somebody with private equity or a bank, and they mention APV, that's what it's about. Just remember, it's about changing capital structures and figuring out the value of the tax shields measured against the cost of the capital. And by the way, in the academic setting, people would say that changing capital structure creates no value. Because theoretically, as you have more tax shields, you have higher costs of the debt, and so therefore they offset each other. That the market will efficiently price that. And I'm telling you that that works great in a textbook, but in the real world, the market isn't that efficient. And you can exploit that, and the banks do all the time. Right? So, questions about that? So, again, practically, here's what this means to you. So, as I said, your graded homework assignment, and I'll give you a hint if you see what company I was looking up at Bloomberg at the top of the screen, will be available at 4:30. Okay, so at 4:30, you'll need to basically go find out which company you need to do the work on, and you'll have to do the 5 forces analysis and get the RV screenshot to get the industry ROIC and the industry WACC. Right? That's what's going to be due Monday at 10 a.m. plus your write-up of the 5 forces. Right? So again, Monday, in lieu of class, you'll be watching the YouTube videos. So watch the YouTube videos that I'll post over the weekend. They'll talk to you about how to do financial statement conversion. You'll have to practice the conversion. We'll talk about it in the webinar. And then next Wednesday, I'll give you a graded homework assignment on that in the webinar, which you can watch as a video after the webinar is over. And again, that'll be due the following Monday. So our next physical class will be a week from Monday. Okay? Otherwise, have a good weekend. Stay safe in the snow. Not a surprise. Given all the snow, it's not a surprise. Right. Yes.
Yeah. So for economic profit, can you explain this table again?